Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and those 10-year note yields trapped in kind of a range that we've seen. And if you look at what's happening across the macro picture, stock market selling, we saw gold rally about 20 bucks on Friday. We've seen the dollar getting hit. We've seen a lot of questions coming out of Washington and from the Fed, and yet the bond market seems very, very tired and is still waiting for a catalyst moment, which many thought was going to be FOMC when the Fed came out on Wednesday. Many thought it could be the resolution of trade and the budgets that we're talking about in Washington. That didn't happen. We're still kind of waiting for something. We're not making that aggressive move towards 3%, nor are we seeing buyers come in and lift us through key levels 280 down to 275 in yield. So right now it seems the bond market very, very tired, still very range bound, almost eerily so. And if you look at volatility in the bond market, while we're seeing volatility rise in other areas, it's very ho-hum, running roughly steady to modestly lower across the board in Treasury. So right now the Treasury market seems like it's still waiting, and it's not even fearful of something coming. When you look at yield curves flattening, and when you look at the potential for maybe only modest inflation moving ahead with GDP growth expectations on the decline, you would think the bond market would be telling us something other than ho-hum, but it really isn't. And right now I think it's really coiling like a spring, and we could certainly see some big move in the bond market in the coming days if things continue on the path that they are. And as we talk about this week, we had the first press conference and first FOMC meeting chaired by Jerome Powell, and I think it had what I call 5 minutes of success, because it really did go off very well. It was a short, succinct press conference. He talked about what he wanted. He hit on all the key points as far as the economy, as far as the Fed policy, as far as what the Fed wants to do with its balance sheet, and it seemed like the market took it very well. And it wasn't until the next day that stocks fell out of bed, and it wasn't until the next day that we saw commodity prices trade all over the map, and we saw the dollar get hit. So I think right now, the market is still kind of waiting to see what the Fed will do. Yes, the Fed intends on raising rates 3 times this year, with one done this week, so they have 2 more to go. I think there was a hope there that the Fed might raise 4 times this year, and I think that can kind of come off the table, at least with the uncertainty that we're seeing priced into the yield curve, into commodity prices, into a declining stock market. And those are things that new Fed Chair Powell is going to have to deal with. Obviously, we're not going to see him deal with those this week, but I think right now as we head into the weekend, the bond market seems very tired. Next week we get some data. Obviously, it's going to be a shortened week with a holiday. So the following week we'll get employment. That'll be our next real big number day. But declining stocks the way they are and the bond market not reacting the way it is not something we're used to. So look out. I think bond bulls will be the winner of this if the stock market continues to decline the way it is. This is Todd Colvin coming to you from the floor of the CME Group.